Hi, everybody. Welcome to Friday's Focus on Finances. My name is Jamie Fleming, and today we're going to be talking about the mega backdoor Roth and is it too good to be true? So a mega backdoor Roth is actually a special type of 401k rollover strategy used by people with high incomes to deposit funds in a Roth individual retirement account. This little-known strategy only works under very particular circumstances for people with plenty of extra money they would like to stash in a Roth IRA. If that's you, this is what you need to know. So, IRA account basics. Before outlining the mega backdoor Roth, you need to understand how Roth retirement accounts and backdoor Roth conversions work in general. So let's look at the contribution basics for a Roth. Roth retirement accounts like the Roth 401k and the Roth IRA let you contribute money you've already paid income taxes on. In exchange for these post-tax contributions, you don't pay a dime in income tax on qualified withdrawals in the future. Who doesn't like tax-free income, right? If your employer offers a Roth 401k option, anyone can contribute regardless of their annual income. But not everyone is eligible to contribute to a Roth IRA. For tax year 2021, investors filing income taxes as single must have a modified adjusted gross income of $140,000 or less per year to be eligible to contribute to a Roth IRA. Those filing taxes as married must have a household modified adjusted gross income of $208,000 or less per year. If you meet these qualifications, you can contribute up to $6,000, $7,000 if you're over 50 per year as of 2021. So let's look at backdoor Roth IRA basics. If your income is above the thresholds I just described, you cannot directly contribute to a Roth IRA. However, a backdoor Roth IRA conversion lets high earners roll funds from a traditional 401k or traditional IRA into a Roth IRA. To simplify a somewhat detailed process, you'll first want to get your money into a traditional IRA. If you aren't doing that through direct deposit, you'll need to roll money from a traditional 401k account into a traditional IRA. Then you convert the traditional IRA to a Roth IRA. Sounds simple enough, right? Well, let's get into the details. This almost always involves paying income taxes on any funds being rolled into the Roth account that had not previously been taxed, which is why you want to do this as soon as you can after you actually deposit the funds into a traditional account to minimize potential gains. There are no income restrictions on who can do a Roth IRA conversion. This is the beauty. Contributions made to the traditional IRA must abide by the IRS annual contribution limits during the year you make them. You can get around these constraints, however, by rolling funds from your workplace retirement plans, which have higher contribution limits. So how does a mega backdoor Roth work? A mega backdoor Roth lets you roll over up to $45,000 from a traditional 401k to a Roth IRA, all without paying any taxes you'd normally owe with such a conversion. So let's note that pursuing this strategy only makes sense if you've already maxed out your annual 401k and IRA contributions, and you still have a relatively large chunk of cash that you'd like to get into a Roth IRA. This is very common over the last year and a half during COVID. People found themselves with extra cash on their hands. So this is a good strategy to look at if you're in this situation. In addition, you must be enrolled in an employer-sponsored traditional 401k plan that permits both after-tax contributions and in-service withdrawals. So let's look at after-tax contributions. Once you've maxed out your employee 401k contribution limit for the year, some plans allow additional after-tax contributions. As the name suggests, these contributions comprise money that have already been taxed. Roth contributions are similar, but earnings on after-tax contributions are taxable upon withdrawal, while Roth earnings are free of tax. So why make after-tax contributions? They can still help you avoid capital gains taxes. Let's look at in-service withdrawals and what that means. Most, but not all 401k plans let participants take withdrawals from their accounts while they're still employed. These in-service withdrawals are a necessary part of the mega backdoor Roth process. You make after-tax contributions, then immediately take an in-service withdrawal before the contributions generate returns that would be taxable during a rollover. If your plan does not permit in-service withdrawals, you can still do a mega backdoor Roth after you leave your current job, but you'll probably owe taxes on any investment earnings during a rollover. If you're self-employed and use a solo 401k plan, you may be ahead of the game. Not all major solo 401ks providers allow for after-tax contributions and in-service withdrawals by default. But if yours doesn't, you may be able to customize your plan relatively easily and inexpensively to allow for these. We do this a lot for our high revenue generating solo entrepreneurs. So let's look at 401k contribution limits, because this is the key to the mega backdoor Roth. Remember, you can't make the after-tax contributions required for a mega backdoor Roth until you've reached your 401k employee contribution limits. Lots of contributions going on here, but we're going to break it down. So your 401k employee contribution limit is $19,500 in 2021, or $26,000 if you're over the age of 50. This isn't the only 401k contribution limit that exists though. Your employer also has one. The employer can contribute up to enough to bring your total contributions to $58,000 or $64,500 if you're 50 or older. If your company isn't maxing out its part of the deal, you actually may be able to make up the difference with your own after-tax contributions. This is a huge step. So let's assume no employer contributions for a moment, and let's look at the numbers. The maximum you can contribute this way would be $39,500 or $45,000 for those of you who are 50 or older in 2021. But chances are your employer is contributing some amount to your future. Here's the mega backdoor Roth math and how it works. Take someone who's under the age of 50 and has maxed out their annual traditional 401k contributions. This individual's employer offers a standard 6% matching. So we have $19,500 in individual contributions plus $1,170 of employer match. This equals $20,670 in total contributions. If you're under 50, remember the total maximum is $58,000. That's the total 401k limit for those under the age of 50. If we minus the contributions to the pre-tax employee and employer match of $20,670 in standard contributions, we're left with $37,330 available for after-tax contributions. So once you have your after-tax contribution maximum, you want to contribute up to that amount to your traditional 401k and then roll that amount over into a Roth IRA. And you can do that at a brokerage account of your choice. Any standard pre-tax contributions should remain in your 401k account unless you want to pay taxes to convert them as well. But we're just talking about after-tax contributions at this point. So complete the rollover before earnings accrue. You'll want to roll over your money as soon as possible because you want to minimize the likelihood your funds see any investment returns as these will be taxed in the conversion. If your after-tax contributions do end up generating investment growth, the IRS does allow you to split up the funds, rolling the after-tax contributions into a Roth IRA and the investment earnings into a traditional IRA. Those just have to be tracked accordingly. So let's look at what's called the mega backdoor Roth and the pro rata rule. This is a little complex, but you would have to do these calculations and make sure depending on your 401k plan that's available to you. 401k withdrawals are generally subject to something known as the pro rata rule. This rule says you can't exclusively withdraw pre or post-tax contributions from your traditional 401k. You must take out an amount equal to the ratio of your contribution sources. So if you had a traditional 401k balance of $100,000 and $80,000 of the balance came from pre-tax contributions and $20,000 was from post-tax, each one of your withdrawals would take out $8 of pre-tax money for every $2 of post-tax money. For the mega backdoor Roth, the pro rata rule means you can't exclusively make an in-service withdrawal of just post-tax contributions if your traditional 401k balance includes a mix of pre and post-tax monies. Instead, you may need to roll over your entire 401k balance in a mega backdoor Roth maneuver. In a situation like this, it's best to roll your pre-tax contributions into an IRA. That way, you're not creating a tax event for you. If your employer tracks pre-tax and post-tax contribution amounts, as well as their growth, you might be able to get around this and simply withdraw the entirety of your post-tax contributions outright. This would be the easiest and simplest way to go. Here's another wrinkle to consider. Even if your traditional 401k balance is zero at the beginning of the calendar year and you only contribute to a Roth 401k before you reach your post-tax contribution threshold, you may still end up with pre-tax contributions in your traditional 401k. And that's because any employer 401k matching contributions must be placed in a non-Roth account. This means you may owe taxes on that money if you try to convert the entirety of your balance. Or you can simply move your employer contributions into a traditional IRA or leave them in the 401k to continue to grow pre-tax and tax deferred until you use the funds later on. So who should really consider a mega backdoor Roth? Before you get too excited about the ability to go above and beyond the typical $6,000 to $7,000 per year, Roth IRA contribution limits, it's important to understand that a mega backdoor Roth strategy is only suited to certain investors. Let's check out the following scenarios to see when a mega backdoor Roth might make sense for you. So first, you've already maxed out your traditional 401k contributions. Second, you're ineligible for direct Roth IRA contributions because your income is too high. You would like to contribute more money than the annual IRA limits. You've already taken care of other key financial goals like paying down debt, saving for college, or saving for shorter term objectives. You have sufficient extra income or money to contribute on an after-tax basis. Your company's 401k plans allow for both after-tax contributions and in-service withdrawals to a Roth IRA or transfers to the Roth 401k portion of the plan. It's important to not adversely affect other areas of your financial life when deciding to contribute after-tax dollars. Let's look at why some companies do not allow the mega backdoor Roth. Even if you have the extra cash and a 401k plan with the necessary features that would allow you to complete the mega backdoor Roth rollover, some companies just simply don't allow after-tax 401k contributions. In many 401k plans, after-tax contributions would prevent the plan from passing what's called a non-discrimination test, meaning they don't have what's called a safe harbor plan. The IRS limits in the highly compensated non-discrimination testing, the IRS limits how much money highly compensated employees can contribute to certain retirement plans relative to the contributions made by other employees in the same plan who are not highly compensated. Since non-highly compensated employees generally can't save more than the traditional 401k limits, most plans would not pass the non-discrimination test if they allowed after-tax contributions. So you want to look at your plan, have it evaluated. If it's a safe harbor plan, you're in a different situation and this wouldn't necessarily apply. If you don't have the necessary plans in place, but you're still looking to invest the extra cash and you like the idea of the mega backdoor Roth, let's look at some alternatives to the mega backdoor Roth. If you're determined to save extra money for retirement, there are a few options beyond this strategy. You could invest in a taxable account. Buying and holding common stocks that don't pay dividends can work well to accomplish a similar result if the goal is to leave money to the next generation. This works because the stocks grow tax deferred because you're not selling them, you're buying and holding them. And then at death, the heirs get what's called a step up in basis to the value at the date of death. This makes all the capital gains become not taxable. If your stocks do pay a dividend, you'll owe income taxes on those payments annually, though, but it still may be at a lower tax rate than your other income. So it may still be a good option. And then at death, if the stock is appreciated as well as pay dividends, they'll still get a step up in basis, and any capital gains would then not be taxable to your heirs. You can make a regular backdoor Roth conversion. If your retirement plan lacks the elements necessary for a mega backdoor Roth, just stick with a regular backdoor Roth IRA conversion. Even if you make too much for a Roth IRA, you can make similar non-deductible contributions to a traditional IRA that you then convert to a Roth. But make sure you do not use other pre-tax dollars in any kind of IRA like SEP IRAs or simple IRAs, or you will create potentially a taxable event here. You can contribute to a Roth 401k. While this option doesn't provide a way to make big extra contributions, you can get the tax-free withdrawals you crave by maxing out your annual contributions to a Roth 401k. Here's a final word on mega backdoor Roths. If you've got the income and a 401k plan that makes a mega backdoor Roth viable, you're in an advantageous position to save a hefty sum for retirement and enjoy the tax-free benefits of the Roth IRA and freedom from required minimum distributions. This is really key to Roth IRAs versus traditional IRAs. I run into this all the time with new clients that are coming in, and they don't need as much money as the required minimum distributions require. So they're having to take out as a taxable event money that they don't need. So converting to a Roth IRA before this happens will save you money in the long run and allow for greater tax-free distributions later on. And if the mega backdoor Roth isn't a fit for your situation or income, no sweat, you also have options. As with all complicated retirement strategies, the best course of action is to speak with not only a tax professional, but also a financial advisor before considering a mega backdoor Roth conversion. You don't want to end up with a mega front door tax bill if you opt for this strategy without actually understanding all the moving parts first. This is a lot of information. So if you're interested in how this strategy might work for you, please take advantage of our complimentary consultation. Thanks, everybody, and we'll see you next week on Friday's Focus on Finances.